Dilution. It's a word that makes REIT investors wary, especially when new shares are issued to fund a property-for-share swap. More shares mean thinner slices for everyone, unless the new assets boost cash flow enough to lift dividends per share. Too often, these deals feel like shell games. More properties, more shareholders, but no real improvement for your payout. But RL Commercial REIT has broken the mold, showing that growth by infusion can actually be dividend accretive. Their story starts with a 9-mall transaction. In August 2025, RCR acquired 9 retail malls valued at over 30 billion pesos, funded entirely by issuing nearly 4 billion new shares. On paper, dilution risk was obvious. Share count jumped from just under 16 billion to almost 20 billion overnight. Most investors would brace for flat or falling dividends. Instead, RCR's numbers tell a different tale. Total assets surged from 109 billion to 140 billion pesos, and revenues for the first 9 months of 2025 climbed 30%. The new malls weren't symbolic. They delivered real, rent-producing space and income. The key question, was this accretive for each share? Look at the dividend history. Pre-infusion, quarterly payouts hovered around 0.1047 to 0.1049 pesos. After the infusion, dividends stepped up, 0.1060 per share for the partial quarter, then 0.1112 for the first full quarter, with all 9 malls contributing. Not only did the share count expand, but dividends per share actually grew, even factoring in mid-quarter timing. Some skeptics will point to initial earnings per share dilution. True, EPS for the first 9 months of 2025 was down year-on-year. But the timing explains it. Asset contributions lagged behind share issuance in partial year windows. When the new malls had a full quarter to deliver, DPS improved. Importantly, RCR operates with zero financial debt and maintains a 90% payout ratio, ensuring dividend growth remains well covered and sustainable. Portfolio occupancy holds steady at 96%, adding confidence to future performance. So, is the 9-mall infusion accretive? The answer is yes. Dividends per share went up, not down, while assets and income expanded. That's accretion, not dilution. For investors, the next proof points to watch are sustained DPS growth, healthy distributable income coverage, and mall performance resilience. The dividend history has spoken. This infusion is landing firmly on the right side of the equation, turning skepticism into cautious optimism.